Can you hear me? If you can hear me, just let me. There we go. It just takes a little bit of time to catch up. So sorry about that. I can. I think now you can hear me. Fantastic. So welcome to the week ahead for the coming week with me, Fiona Sincotta, Senior Market Analyst at City Index. So without further ado, just take a quick look to read through the risk warning. I'm just going to mute myself for a few moments. Okay, great. So let's quickly move on. Quite a lot to get through. Let's just start. Yeah, I know usually we start by going through the economic calendar and seeing sort of what to be watching out for next week. But actually, this week we're going to start with the outlook for Nvidia. Obviously, Nvidia will be reporting their earnings next week, and that has the potential to influence the broader economic market, the broader financial market, particularly if we think about sort of how Nvidia has been such a strong participant and largely responsible for the strong rally that we've seen in both the S&P and the Nasdaq, taking them both to record highs a little bit earlier in the summer. So as far as earnings are concerned, due to report on the 28th of August, so that would be on the Wednesday next week. It'll be after the close. And basically, yeah, I mean, if you just have a look at the chart here, I mean, we look as if we're looking at the Nasdaq chart itself, you know, given the such close correlation and how much of a part that Nvidia has played in the rally. So that does mean that it's very much in focus for its earnings. It does trade off its record highs heading into the earnings. But it still trades up around 162% year to date and 25% up so far in August. So that does obviously mean that expectations, as we know, are fairly high. Now, Wall Street is expecting revenues of 28.54 billion. So that's revenue growth of around 211% year on year, down slightly from revenue growth that we saw of 250% in the same period last year. Meanwhile, EPS is expected to come in at 0.64. Now, I think, you know, obviously the just bear with me one moment. Sorry about that. So yeah, so basically the data center, basically what we've seen, what's driving the popularity of Nvidia is demand for its chips, its GPUs, used by data centers. The particularly AI and machine learning has boosted the sales of Nvidia's very specialized chips, GPUs, and they've also benefited from increased demand for the cloud. Now, I think the data sort of center segment which includes those GPU sales and the AI is expected to grow as customers such as Amazon, Microsoft, and Alphabet. So these big names, they're all customers and clients, and they use Nvidia chips. They actually account for around 40% of its revenues. Now, obviously, these earnings aren't without their risks. There are some concerns regarding sort of Nvidia's ability to be able to meet demand, particularly given that demand is so strong, and sort of concerns over supply chain constraints, as well as the market will be looking for an update regarding Blackwell as well. I think the other thing just to watch out for is, you know, we are sort of in a little bit of a period of economic uncertainty. We'll talk about that in a minute. There are sort of growing concerns potentially of a recession in the US. Still, these are very minimal, but they're just increasing slightly, and that sort of could curb business spending if it were to develop. Obviously, that's still very much a high end, sort of a higher level risk that's not really playing out just yet. But also the other thing that we're noticing is there is obviously increased competition. So that is something that may be mentioned as far as the outlook's concerned. But anyway, despite those risks, it's fair to say that Wall Street remains very bullish on Nvidia. Citi and Goldman Sachs have reiterated their buy ratings. Nvidia does actually have 66 buy recommendations compared to 8 holds and 0 sells. So this is the chart that we're looking at the moment. We can see that Nvidia has run into resistance after recovering from the August 5 low at $90. Recovered, just run into resistance here. This is around the 130 level. It's the falling trend line dating back from the all-time high on June the 20th. And we can see there's a fairly strong sell-off. That was yesterday, just as we had a few concerns and wobbles over the Federal Reserve Chair speech and the outlook for Fed rate cuts, but I'll come to that shortly. And that's just, you know, seeing this bearish engulfing candle. So as far as, you know, support is concerned, I think there is a little bit of minor support here around the 120 level. That's the 50 SMA. And then we do have a little bit further down, you got 100 SMA down there around 107. But I think, you know, really, we're not really going to see sort of, we'd need to see a break below this level here in order to see a lower low. That's the 90 level. That was the August 5th low. So in order to sort of really see this downtrend continue, we would need to see a break below that level there. As far as upside is concerned, buyers going to need to take out the 130 to bring into play the 136 and the all-time high of 140. So that is Nvidia. As I said, I think Nvidia does have the potential to influence market sentiment more broadly and impact the S&P 500, the Nasdaq. But just let's bring in the Nasdaq actually whilst we're talking about it. And we're also going to talk about the other key event next week. Look, as I said, it's a really similar chart we can see here. Other key event for next week is core PCE, US core PCE. Now, that's the Federal Reserve's preferred measure for inflation. And, you know, the markets and the Fed are going to want to see a continued decline in inflation to support these rate cut expectations. I mean, obviously, we're doing this this podcast now ahead of the Federal Reserve Chair Jerome Powell's speech at Jackson Hole, which is in a few hours' time. So I think, you know, if there is anything that has sort of been left by Jerome Powell, then that data will be, then that hole may be filled by the core PCE. But I think, you know, where we are right now is that the Fed seems pretty comfortable with inflation cooling towards the 2% target. Obviously, we've got inflation is cooling. The market is fully pricing in a rate cut from the Federal Reserve in September. Fed speakers, the Fed minutes, have all pointed to the fact that the Fed is comfortable with cutting rates in September. We even had some policymakers in the FOMC minutes suggesting that they were ready to cut rates in July. So I think we know that the rate cut is coming. Maybe Federal Reserve Chair Jerome Powell will use Jackson Hole as sort of to explain where the Fed is. But I think what's interesting is that the market is actually pricing in around 1% worth of rate cuts this year, which is, it feels quite aggressive. So I think we're going to hear from Fed Powell that rates will be reduced, but potentially he might focus on the idea of it being a slow and methodical process rather than anything else. So that prospect of cooling inflation, if we still see it falling, then that's going to be supportive of the idea that the Fed is looking to cut interest rates and starting the rate cutting cycle. I think the risk now, though, is if we actually start to see a fall in monthly inflation, so not an easing, but if we see a negative monthly inflation, that can point to deteriorating demand. And there are a little bit of concerns as far as a recession in the US is concerned. We had that data for the non-farm payroll, which was much weaker than expected, which raised concerns of a recession in the US and sent stocks sharply lower, as we can see here on the 5th of August. That was the Monday following the non-farm payroll data. We also had this week, didn't we, the downward revision of US payrolls. Now, they were downwardly revised by a chunky 818,000 for the year ending March 24. So that tells us as well that the US jobs market is actually weaker than what was initially reported, which again, it did raise some concerns in some markets. I think it's fair to say that. If we just have a look, the Nasdaq actually ticked higher on the day that data was released, but we did see a drop off yesterday. So I think that those concerns are just rumbling around, and I think if we start to get sort of falling inflation, a sharp deterioration in the labor market, then that could fuel recession fears, which that would obviously be negative for the outlook for stocks. So just as far as technically, we've seen that recovery from the August 5 low of the 17,236, recovery rising back above the 200 SMA, ran into resistance just below the 20,000 level, which was the level, the June high, also the round number just below that, and we've just seen this sort of coming off, and it's testing that 50 SMA as we speak. So if we get some encouraging sort of comments from the Federal Reserve, then that's going to be the level that buyers are going to want to be taking out. If we get cooling US inflation next week, if we get a rise above the 20,000, then obviously that does bring the all-time high of 20,750 back into focus. On the downside, we're watching this support. This is the rising trend line support just below 19,000. This support goes, this trend line goes back to November 2023. So if we do get a break below there, and that's also the 100 SMA, then that's going to bring 18,500, which was the March high, into play. Now, just while we're on US indices, let's also take a look at the S&P 500. Similar sort of picture going on. We've seen that recovery from the August low. We've seen a rise above the rising trend line, which actually dates back again to that November 23 level, run into resistance just below the all-time high at around the 56.30. If we do get sort of signs of the Fed comfortable with the health of the US labor market and inflation and cutting rates, then 56.70 is going to be the level on the upside to take out. On the downside, you've got this level here, which is what, 5,500. So it's just around the high that we saw in June. It's the round number. It's also that rising trend line dating back to the November last year. So a couple of pointers there. So if we get a break below there, then be watching out here for around the 53.60 level, which is the 100 SMA, and it's also the May high. So that's on the indices. Let's just take a look at what's going on in the US dollar. I think, especially when we're talking about the Fed and inflation and Jerome Powell's day and what's going on with rate cut expectations next week, then this is always a good one to have. Let's just so if we can see, yeah, US dollar, it's fallen down from the June highs above that 106 level. Fallen really quite sharply and quite steeply in recent months, and we hit a low, didn't we, of just under 101 this week. Now, interestingly, it's trading below this rising trend line. We've got the 50 SMA. Looks like it's going to be cutting below the 200 SMA, and that would be a death cross signal if it takes place. We're finding more selling. Then watch out for this level here. This is the 2023 December low, which is just above the 100. It's 100 and let's get it for you, 100.6. But just watch here, we've also got the RSI tipping into overbought territory, so we might just find that there is some consolidation around this level to get that RSI back into positive territory. On the upside, buyers are going to be looking for this level here, I think around the 102.80 level. That was the low that we saw in March, and also around the last week's high. And just as you know, when we look at the US dollar, I like to take a look at gold. Gold's been a really interesting one, hasn't it? I mean, obviously we've got Jerome Powell's comments, which I think will set the tone for gold for a while to come. But then obviously with the US inflation data next week, if we're finding that we see a continued cooling in inflation, then that's going to keep gold prices supported. We did find that we sort of broke out of this rising channel, ran to an all-time high this week of 25.31. It has since eased lower, the price. It's testing the support here at the 24.80 level, which is the July high. We get a breakthrough there, then I'll be watching out for 24.50 as a next level of support. On the upside, if we get a break above here, and it looks like we're just trying to do that right now at the 2,500, so 2,500, then that could open the door to fresh all-time highs. So yes, just as far as other things we're watching, US dollar, Japanese yen. We've got Tokyo inflation data next week. Obviously that comes after Japanese inflation data today, which came in. We saw core inflation tick higher. We also heard comments from Bank of Japan Governor Ueda, who said that potentially interest rates may need to move higher for a more neutral position. Now, obviously, that would be supportive of the Japanese yen, especially if we see this ongoing sort of expectations of rate cuts from the Federal Reserve. Okay, so I think we've got this ongoing idea that we're going to be seeing sort of potentially more strength in the yen and potentially ongoing weakness in the US dollar. Although I think it's worth pointing out that once sort of, the Fed starts cutting interest rates and starts catching up with other central banks which have started cutting interest rates, then we might find that this sell-off in the dollar actually starts to ease. And also, as I said, I think the market's overpricing in those 1% worth of cuts this year, so that could also help the sell-off in the US dollar steady a little bit. But yeah, if we get sort of stronger than expected Tokyo inflation, then that obviously is going to support the view that the Bank of Japan could be hiking interest rates again soon. Just on the downside, if we get a strengthening yen, weak US dollar, I'll be watching out for the 145 level. That's just proving to be a little bit of a struggle to get a close below recently, so that's the level on the downside. If we get below there, then that brings that 141.70, 141.70, which is the August low, back into play. On the upside, immediate support is looking to be around that 146.44, so that's the 23.6% fib level from the high, that 38-year high that we saw here around the 161.80 level, and then the low that we saw at the 141.70. Above here, this is the really key level I think right now to be watching, is 149.40. That's where we ran into resistance on the recovery. It's also this trend line, so it's the 38.2% fib level. It's also the trend line resistance, sorry, bear with me, which goes all the way back to 2022. So I mean, it's a long way back. I think that's probably not very helpful, me moving the charts around like that, but if we just have a look at the weekly chart, then you'll probably get more of an idea of what that trend line is. There we go. So that's going back all the way here. So forgive me, back to 2021. So, you know, a relatively important level if the price does manage to break above that. But as I said, I'm not necessarily putting that as a base case scenario right now. So that's the Japanese yen. Also, we've got inflation data. Sorry, we haven't even had a look at the chart. Here we go, the calendar. Here's the calendar. So we've done Tokyo inflation. We've obviously got the core PCE, and that's on Friday. We've also got Eurozone inflation figures to be watching out for. Now, the market's going to want to be seeing that Eurozone inflation is continuing or is cooling, because we had a tick higher in July. They want to see that inflation is cooling slightly again. I mean, in order for the ECB to be comfortable cutting. That said, I think, you know what, recent ECB policymakers have guided the ECB minutes yesterday, have all sort of guided towards a rate cut from the central bank in September. They've obviously not cornered themselves in as they did in June. So there is still potential for them to move should the data, and there's still, you know, quite a few weeks worth of, about 3 weeks worth of data to come before that meeting. So they do have time to give themselves a way out if needed. But I think the market's expecting around 90% probability of a rate cut right now from the ECB. And I think that could mean that maybe Euro US dollar has topped out for now. I mean, we've seen this lovely rally as it recovered from the 100 SMA, as it pushed higher again here. You know, we've got that idea of US dollar weakness being played out. Recent data, I think, from the Eurozone has been a little bit mixed, in the sense that there has been some concerns over the outlook for growth in the region. Although we did get PMI data yesterday, which was stronger than expected, but I think that could be the influence of the Olympics coming through. We saw service sector activity in France particularly was very strong, which would have just distorted, I think, overall figures as well. We saw German, though, sort of service sector, German business activity contracted for a second straight month. So I wonder whether that run up has actually had its time. The high that we saw there was 111.74. That was a 2024 high. RSI was in overbought territory, so we're seeing it pulling back. It's just sort of coming towards to test the 111 round number. If we did see that level hold, then I think we'll be looking to get above that 111.40 and the 112 level in order to bring the 112.70, which is the July 2023 high, back into play. We do see continued weakness because there's a slight strengthening in the US dollar, or perhaps we hear inflation falls quite considerably in the data next week, then we could see this price look to take out the 111, and that then brings in 110 round number as really the next sort of logical support level. Okay, so just moving on now, let's also have a look at the DAX whilst we're just looking at the prospect of rate cuts and the inflation data from Germany. We also have inflation data, actually. So inflation data in Germany. We've also got retail sales as well to be watching out for. Yeah, so in data, again, they'll be looking for Germany for inflation to cool, but it's got to that stage where we want it to cool, but we don't want to see it drop too sharply, because that's just going to get the market a little bit nervous that a recession might be coming. But again, we've seen a really nice rally from the recovery. This is on the prospect of further rate cuts, the fact that the Fed could also be cutting rates as well, risen above the 200 SMA, taken out support here, the resistance here at 18,000, heading up to this level here. I think maybe could be the first. I mean, we've got a little bit of resistance maybe around it where it is at 18,600, and then around the 18,780, so 18,900 ahead of the all-time high, which is the 18,930. That's the level that we're going to need to break above in order to get to fresh highs. RSI is supported with further gains. Support here at 18,000. I mean, obviously you've got the 100 SMA in there, a minor support at 18,270. But you know, if we get any recession jitters, I think that's something that might pull the share price, the DAX, lower. Also, if we get an unexpected increase in inflation, that could also just unnerve the markets a little bit. And then just finally, just looking ahead to what else we've got. We've got retail sales from Australia as well, and GDP from Canada. Just a little bit conscious of time, wanted to get in. We've got some data from China, which is always worth considering. You know, we think recent PMI data from China has actually just raised concerns over the health of the economy over there. We saw the manufacturing PMI last one was at a 5-month low in July, and you know, factory orders and low prices. Factory orders fell to a 13-month low, so there are sort of, you know, a few concerns still regarding the health of the manufacturing sector. Non-manufacturing exports were also slower, grew at a slower pace, so there is a little bit of concern here. Interesting chart though. You know, we've been trading in this downward channel since mid-May. Seem to have found a support down here on that 6th of August down there at 11,500. Recovery is looking to just test the 200 SMA. Now, I think that's going to be quite key if we do get a move above the 200 SMA, because we get some upbeat numbers, we get a boost in sentiment. Then a rise above out of the channel at 12,000 could bring the sort of 12,300 level back into play, and even 12,400. That'd be levels we'll be watching. But watch out here. You know, I think not only is it the 200 SMA, but it's also a level which sort of offered some support around this level. So if we get a rebound lower, correction lower, then that could potentially even bring the 11,500 back into focus. Sorry, just bear with me whilst we're talking about China data. Let's just have a look at what's going on with the Hang Seng as well, because again, I think it's a really interesting chart. Again, we've been sort of in this downward trend since May, downward channel. We've seen the 50 cross below the 100 SMA. Is it going to cross below the 200 SMA? Not sure. Doesn't look like it is, because we've got this little bit of a recovery now going on after we found that bottom at 16,430. It's risen out. It's risen above the it was broken out above the 200 SMA, also broken out above the falling trend, the upper band of the falling channel, but it's just struggling around that 100 SMA. So watch out for that. 17,715, that's the level that needs to be really taken out. That's also the weekly high before we can move higher and look potentially towards the 18,350. On the downside, support there, 17,150, that's the 200 SMA. We get disappointing data if there are concerns over recessions, sentiment takes a hit broadly, then also watch out for, if we get a break below there, to watch out for 16,465. That was the 16,430, the low that we saw on the 5th of August. So I hope that you've liked everything that you've seen. That is all from me today, and I look forward to seeing you next week. Have a great week.